We decided to create a video to help answer a lot of questions that we're seeing pop up from our clients. And I think this is the easiest way to tackle your questions. We got myself, Tyler Furukawa here, and Nash Anderson.
All right. So we wanted to lay out the funding priorities that we feel are important for people to understand for their policies. These are our opinions. Others might feel a little differently. At least some groundwork for you guys to work from. First and foremost, we got to pay the annual premiums of the policy. So this is when you have a 90-10 split policy, that 10% of actual whole life insurance, that base premium, got to fund that. This is based on insurance, even though we're using it in a different way to create this infinite banking or savings vault. So we've got to pay those annual premiums, can't let your insurance policy lapse. Secondly, pay any interest or debt servicing. So if you're taking policy loans, definitely want to service that policy interest. This helps keep that interest simple. You don't want it compounding and building a higher loan balance, because that's what it'll do. It'll just tack on that unpaid interest to your loan balance and balloon if you let it go over time. Number 3, max out PUAs, paid up additions. This is that cash value component of the policy, really making that infinite banking concept go to work. So on that 90-10 split we talk about, it's that 90%. And so this is the cash dump in, basically gets that compounding magic working for you. And then lastly here we got 4A and 4B, because some people prefer one way or the other. 4A is pay back your policy loan principal. Some people do like to do this as the savings vault or the dry powder build up for the next deal or next opportunity. Others don't like to do that. And some people may prefer, if you've got more money, to not pay back the loan principal and actually open up more policies and continue that infinite banking magic. Tyler, anything to add on the priorities?
Yeah, sure. And I do want to just emphasize again, this is our guideline. This is how I really fund my priorities and my policies. I did choose 4B in the sense that I felt I have my money working for me, even there is some debt on it. I'm able to leverage that and really velocize the returns there. So I do have multiple policies that I'm layering on. Others, though, may feel more comfortable at some stage in life paying down that loan. And later on in my stages, probably 5 to 10 years from now, is when I would stop opening up more policy, paying back the loan, having that cash value and vault there and build up for potential later stages of income down the line.
Yeah. Thanks, Tyler. I completely agree. Just where I'm at in my life as well. So hopefully this helps with the funding priorities. We're now going to go into each one of these a little more in depth next.
So as we mentioned, priority number 1, of course, is paying the premium. The initial premium payment is conducted when you review and accept your policy and what we call it delivered. So to put it in force, you do make that first annual premium payment. There's ways after that you can manually start paying your premiums. You'll get a notice on your policy at least 2 weeks ahead of time. So you'll be able to fund it prior to your policy anniversary date for your next premium payment. Or you could go on your portal and set up an auto pay. And that's simply just linking up your bank account, having it pay. Again, you could choose that window. It could be 2 weeks prior or 2 weeks after your premium is due, and have that kind of automatically paid. The most efficient way we have it set up is to be on an annual pay. Again, you could choose different options. There's a monthly or quarterly premium payments. Just keep in mind that you are going to be paying a fee to have it. So if you multiply that monthly rate by 12, typically you're seeing a 4 to 5% fee that you'll be paying a larger amount overall to have that feature built in. Another feature we add on, and this is no cost, is to have what we call an automatic premium loan. So in the event you forget to pay it, the policy won't lapse. It essentially will automatically take out a policy loan in order to cover that premium payment. Again, this is something we don't recommend, but it's there as a fail-safe mechanism. And then, of course, we're also doing a reduced paid up option designed into the policy. This is an option, so that kind of determines what your funding period is. So whether it's 7, 10, or 15 years, or even 5 years, at that funding period amount, we would be exercising that option where we reduce and make the policy paid up so that there's no more annual premiums required for your policy going forward. Nash, you have anything else to add?
And maybe just going off of that reduced paid up. After that, those dividends, we set it up so it's buying more paid up additional whole life insurance without any more money out of pocket. And that's why you keep seeing your death benefit grow and your cash value grow over time, which is really nice. And it remains, you can still access all of that tax-free if we do it. All right. And priority number 2, paying the interest and the debt servicing. Paying your policy loan, or some people have third-party lines of credit to save on interest. This helps keep the debt simple interest and not add that interest balance to your loan balance every year when it can really eat into your cash value. So you really want to make sure your cash value is compounding and your debt is remaining simple. If you don't pay it, that debt interest will start compounding. It loses the magic there. Just a brief overview of what that kind of looks like with simple math at 100 grand, 5% interest rate, looking at simple versus compound interest, a flat 5,000, 5% of 100 grand for 20 years is 100,000. Compounded, you're looking at 5,000 year 1, but then it starts adding to that loan balance. So in year 2, you'd be getting interest off of 105,000. So it starts growing from there. So you can see after 20 years, it's a big difference, 65,000 or 65% more, which is a pretty big difference. So hopefully that helps put the math into perspective. You should only pay up to the pre-calculated amount of the interest. It gets a little nuanced and we'll go into more detail with some kind of live demo videos later. But this pre-calculated amount is prorated to your anniversary date. I know this can be confusing. So when you take a loan, they prorate your interest to your next anniversary date. If you pay it early, then you actually get a refund based on that proration. We will go into that a little bit in kind of a live demo, try and show you how that works in later videos. Most insurance companies will charge interest up front. So you'll see your max loan against your cash value. It'll be a little less than the number. If you pay that interest before that policy anniversary, you get a little credit back. Just for reference, the Guardian policy loan interest, they're stated on the old policies pre-7702 at 6%, the new policies post-7702 IRS law change at 5%. But actually, if you pay it right on that 1-year anniversary date, it comes out to 5.67 and 4.676 respective. So a little confusing, but the interest rates are actually a little lower. If you do not pay them, then you are charged that 6% on the old policies and 5% on the new policies. Complicated topic here, but Tyler, anything to add on this one?
Yeah, this by far is where we get asked most of the questions. As people start pulling loans, you'll see on your portal how the interest due, payoff amounts. A lot of that can be confusing. We're here, you can just reach out to us. We can go in the portal and also help with the math to explain with it. But yeah, as Nash mentioned, not only is it the number they're using is either that 5.66 or 4.76, but they're also prorating it to your anniversary date. So say I pull out a loan today and Nash pull out a loan today. The interest calculated will look different. And that's where some people, if you're comparing it with your buddy, it looks like everyone's getting charged a little bit different. It is prorated to your specific anniversary date. And as Nash mentioned, you pay at any time throughout before your policy anniversary date, you'll get some of that pre-calculated interest back. So your loan amount or loan due, that amount will get reduced by your payment along with whatever was refunded for the pre-calculated interest. But yeah, we'll show a live demo with actual numbers and a policy so that hopefully that'll provide some clarity to this. All right, and priority 3. So that's after you made your premium payment, you're paid your debt servicing for that year. Now you want to make sure you max out your PUA, because the PUA really is that cash dump. And once you make that PUA, that's when the compounding dividends will start occurring. So once it's in there, it's locked in there. So of course, after those first 2 priorities, make sure you max out your PUAs. Again, it is flexible, especially with Guardian. And that's why we like Guardian so much, is that you're able to do it anytime throughout the policy year at any amounts up to your MEC limit for that year. Again, max that out as soon as possible. You'll get that compounding started as soon as that money hits your policy account.
I totally agree. Personally, on mine, it took me a little while to build it up. I wasn't able to fund it with my Guardian policy on day one. Obviously, that would be best, but you can do it when your funds are available. And we create a separate video that kind of shows the resiliency of these policies. So it's not necessarily bad if you can't, and it's going to take you some time. It is just the most efficient, of course, because those dollars go to work for you, as Tyler mentioned.
Yeah, that's a good point also, as far as the carrying over. Also a reminder, if you're not able to max it out, that policy year, that leftover ceiling will carry over to your next policy year, and you can make those back catch-up payments. So say your target amount is 100,000, you only funded 80,000 this year. That extra 20,000 space will get carried over to your next policy year. So you now have the capability of putting in 120,000. So 100,000 for that policy year, along with making that catch-up payment from the previous year. And that can happen every year throughout your policy up through your funding period. And you'll be able to make that catch-up payments without any additional underwriting, without any required approval. You may still be able to do it outside of that funding period, but there's most likely the company will require underwriting and they may not allow you to make that catch-up payment. Again, at least within your funding period, we target to make all your maximum contribution within that period.
And Tyler was referencing the Guardian. Those comments were specific to Guardian. Other companies have different rules or whatever for their policies, so just got to be aware of that. For example, Mass Mutual, you can adjust payments up and down every year, but it has to be on the same day every year. And Penn Mutual has different requirements, which if people are interested, we could go into that in a different video. But all right, priority 4A and 4B, we marked them 4A and 4B because some people prefer one over the other. But after you've paid that policy-based premium, serviced your interest or your debt, loaded up your PUAs, fill up your MEX space, then you can either pay back your policy loan principal, so that those policy loans you've taken from against your cash value, you can pay that back and save it up in your policy for the next deal for drag. And others like to keep that money out, never pay back that principal, and maybe layer on another policy and basically increase your IBC vault size as your cash flow and your net worth grows over time. Different options here. I just wanted to present them for folks to think about and consider for your situation.
As mentioned earlier, the decision point may be in what stage you are as far as your investment or your investment goals. Definitely during the accumulation phase when most of your funds would be deployed out to work for you, 4B is probably the best option. 4A is probably for that later time when you're in more the preservation phase versus the accumulation phase. Mm-hmm. But again, we've seen both sides work. The other decision point probably is, are you able to have your money working and earning a higher return than debt servicing for your policy loan or your collateralized loan? And most of us will feel yes. So that's why most of us have our money outside of our policy for us and continuing.
Just explaining that a little more, maybe that trade-off is if I pay back my policy loan principal, then that interest expense goes down, that 5% or so interest expense. You're not gaining money, but you're not losing that 5%. If you're sitting your money in cash and you've got a big policy loan, cash isn't doing any work for you, or maybe it's in a savings or a checking account or 0.nothing%, probably pay back that policy loan principal. But to Tyler's point, we're all avid investors, so we're probably doing something with it if it's not being paid back.
All right, and just circling back and summarizing what we covered. Again, the funding priorities. So of course, we want your annual premiums paid up. So that is the top priority to keep the policy from lapsing. There is that feature of the automatic policy loan. However, that will impact your cash value. So again, make sure your premiums are paid. And secondly, pay any of that debt servicing. And we're talking about just the interest. And that's to make sure that the interest remains simple and it doesn't compound and grow. And that helps keep your policy growing, compounding, and the debt servicing remaining simple. And that spread over time will be positive. Secondly, max out that cash value by paying your PUAs and maxing that out. That gets your policy going and starting to earn the compounding dividends as soon as those funds hit your policy. And then whatever remaining capital you have then is a toss up for A and for B, those two options as far as either starting to pay down your loan principals, or it may be time to consider opening up another policy and creating larger pockets of money for you to access. Anything else to add? Nah.
And normally, number one, pay those premiums is that smaller hurdle, that 10% of the funding target, how we design them at least. And number three, maxing out those PUAs is that 90%. We like that really small hurdle, small whole life actual expense, large bucket to shove into that cash value component.
Yeah,
That's it.
we hope that this helps answer that question of, I have so much money, what should I do with it? And this is how myself and Nash and a lot of us are utilizing our policies. And again, feel free to reach out to either of us with any additional questions, and we'll be happy to help answer those.